Okay, today we're going to look at advanced market structure. We have looked at market structure in the past on the simple form, whereby we identify that a market structure is when a market is creating higher high and higher low, a new higher high, higher low, higher high, higher low, higher high, until it comes down to break the last higher low, which will now give us a change of character, character. This is a change of character because it means the market can now begin to trade on the bearish dimension, on and on. And we've identified this as a higher high, and this is a higher low. So this is a simple form of market structure, which means when market is trending on buy, it creates a new higher it creates a higher high, higher low. Then when it goes up, it breaks the previous higher high, okay, to create a new higher high. Then it comes down and break the structure again, the last higher high, break the last higher high to create a new higher high. Then it comes down while it continues to preserve the higher low. So it goes up again to create a new higher high, breaking the previous higher high. Then come down at this time around, now break the higher low to create change of character. This is the general dimension of market structure and how market moves, which I have told us. But market does not always give you this simple movement. It doesn't give you this simple movement, which sometimes make people to think that a market is already a sell market while it's still a buy market. Or somebody can think that market is already a buy market while it's actually still a sell market. So today I target advanced market structure, whereby you need to have deeper knowledge of structure for you to be able to pin down every complex structure. So I'm going to be giving us example of a complex structure this morning on a financial market. So let's now look at a structure that looks like this. Okay. Now, you can have a chart that looks like this. And you begin to ask yourself, is it a sell market? Is it a buy market? For example, let's assume this is a 4-hour chart. You have this on 4 hours. So if you go to 1 hour, if you go to 30 minutes, you become confused. But the truth of the market is that this chart, for example, is still a buy market. And let me explain why this market is a buy market. This is a higher high. This is a higher high. This is a higher low. This is a higher low. Now, this market is still, as long as this market has not broken the last higher low, as long as it has not broken the last higher low, it's still going on buy market. So it came down here, almost breaking it, but did not break it, and went up to create a higher high, a new higher high. Then it trended down to create a higher low, and went up to create a higher high, and came down to the same line, but did not break the last higher low. Did not break the last higher low, but on the same line with the last higher low, and returned up to create a new higher high. Came down to create a higher low, and went up to create a higher high. Now, this market, as much as it looks as if it has broken here, it did not break. As long as it did not go beyond this last higher low, the market remains a buying trending market. Now, the only thing that you can do in this kind of market is that when the market is like this, you can go to maybe 30 minutes or 15 minutes, 30 minutes, 15 minutes time frame to trade the structure inside structure. Because if you look at this is a structure inside a structure. Now, up from here to here is a structure. It went down, it broke out, it retested again down, then it went up. So that is a structure. If you go to like 5 minutes, you see that it gives you like a complete structure. But the fact that the market is trending on sell in 5 minutes or in 15 minutes doesn't mean that the entire chart of that particular market is a sell market. It's just a trend in a smaller time frame. So as a forex trader, you need to understand that the primary direction of a market must be captured on a big time frame. On daily, for example, on daily charts, or weekly chart, or maybe 4 hours chart. At least 4 hours chart. Some people can also use 1 hour, because sometimes the structure you can see on 4 hours, sometimes you can also capture it on 1 hour. So you must be able to see the structure on a big time frame for you to determine the direction of the market. Because let me give you an example. Let's assume you see this market when it's going this way, you consider it as a sell market. Let's say this is a pushback. Then you decide to enter a sell. When it came here, it pushed back, it came here. Then if you are still in the market, then the market move against you while you are trying to sell. So that is the reason why we say never trade the market on the opposite direction of the trend. So this kind of market, you should be waiting for something like this double bottom, then you buy. You wait for something like this, then you buy. So this is one pattern of a complex or advanced structure, right? Then I will also try to draw it in another way. Let me also try to draw it. Give us another example. Okay. Advanced market structure, right? So let's look at another example. Let's say a market is going on buy, on sell, okay, buy, trending on buy, okay. Okay. Now, if you look at this market, you can say that immediately this market broke the the higher low. This is higher high. This is higher high. This is higher high, right? Higher high, higher low, and of course higher low, right? Now, immediately this market crossed down here is a change of character. It's a change of character, right? So it gives us a change of character. But the market return up and break this to give us a new higher high. This market has returned back to buy. This market has returned back to buy. Now it comes down here, it's going to go up again, for example. And of course, if it come back again and break this, then change of character. So when a market comes down, you are expecting it to retest, sometimes to retest on this line, then shut down. Or when this market return up, you retest on this line and respect it and shut down. But immediately it crosses this up over again, then the market has returned back to buy, a buy trend. So if it goes up, then you wait for it to give you an opening for you to buy, But if it comes down, below and cut this higher low, then you be looking at opportunity to sell, right? Okay, so let's now look at some simple entry options for us if you want to trade a structure. So I want to introduce us today to how to trade a structure, how to trade a market, a structured market. A simple entry. So if a market is trading on buy, it goes down, it goes up, it goes down, it goes up, it comes down, goes up, it comes down here, it goes up. Now, how do you enter a market, a trending market, or a market that you have been able to identify the structure? Okay, so now when you see a market that is trending on buy, for example, when this market created this higher high, and it comes down, it didn't get to this point and return up above this. Immediately a market comes down and give you something like this. It gives you N shape. When a market gives you N shape, that is the direction of that market. Now, once it broke this and it didn't reach here, you realize it didn't reach this and it went up to break this. Now, you will now be waiting for this market to come down somewhere here for you to buy it. It's as simple as that. Once you see N like this, you can wait for it. Now, there are certain things that you have to look out for to determine where to enter a market. Let me give you such example now. So now, don't forget that all these lines that I drew, they are all candles, different candles. Now, most of the times, when a market returns back here and return up here, and the market reach here and return down here, what we call this, we can call this supply zone, and demand zone. All right, so demand zone. So we have these zones. So what that means is that on this place, there is something here that pushed this market up. So now there is a formation of candle here that you can identify. Once you have identified them, once you have identified this formation of candles, okay, let's assume, let me start the structure so that you can understand it. Now, we have a hen, right? So now, when the market is like this, you know that this is a buying market, right? It went up, it came down, it respected this, it never got there, and it broke this. Now, there is a formation of candle here, in this place, that you can mark. Sometimes it's called order block. Or you can also have a set of candles here that created what we call imbalance. Imbalance in market. Imbalance in market. So when you have this imbalance, when this market is coming back, it's trending down, when it gets to this place, this imbalance, it returns up. So immediately you identify an imbalance in this market, you mark it. Or if you also identify an order block, there is a set of candles you will see that will show you that it's an order block. You mark it. I'm going to be showing you this on chart, right? But I'll give you an example. So this market can also trade down into the imbalance and touch the order block, okay? Then goes up. So as a trader, you are waiting for this market that has gone up. You know, some people, when the market is going up, they jump in, they want to buy. No, that's not the right way to enter. You have to wait for this market to come back because the market must balance itself. Anytime the market trades up, it must return back. It must balance itself. So the market will come back and balance itself. When it comes down to balance itself, you know that this market is not going down. because the institutions that are trading this market are buying the market. So they have given this market the momentum to push up. So that is the reason why it went up here and broke this place. So it really goes, it's gone up and broke this, and when it comes down, when it downs down, automatically it's going to fly up. So you wait for on this zone for an opportunity to join the market. This is how you can identify entry. So, like I've mentioned two things here. I mentioned order block, and I mentioned imbalance in market, or what is popularly called fair value gap. So there's a gap, fair value gap. So there's a gap here. It's an imbalance in the market. So the market will come back and balance the market. So when market comes back and balance the market, then you jump in. Now let me give you an example of candles, the way the candle forms, okay, for you to understand an order block and for you to understand an imbalance in market. Okay, when we're talking about order block, we're talking about sometimes you can have a set of candles like, let's say this is black chalk, so it's going to give us a kind of a, let's say this is our red candle, this is green, so I'm going to use the green as our red candle. So let's assume we have the green candle, then we have another green candle, then we have a green candle, sorry, this candle is, let's say this green candle is our sell candle, right? Then the black candle is our buy candle. We have this one, then we have another sell candle that is pushing it down. We have another buy candle that wants to go up. We have another sell candle that is pushing the price down. Then suddenly we have a buy candle. Then we have another buy candle. Then we have another buy candle. Now, in this market, I want to identify two things for you. I want to identify an order block and a fair value gap. Now, you see, most of the time when you see a market trading, you can see that when this candle established here, another candle comes in here and push the market down. Then another candle comes out here, which has, sorry, why is it? Oh shit. So this candle comes out here with its wick touching the mouth of this. So now this is a balanced market. Let me give you an example of a balanced market. When you have a candle like this that is trading up, then another candle traded down here with a wick in his mouth, another candle traded down here. Okay, now this is a balanced market because the first candle and the third candle touch each other. Okay, they touch each other. Whenever you have a market where a candle stands like this, another candle stands like this, and another candle stand like this, then there is an imbalance in this market because this candle and this candle did not close the gap between this long jump. Now this is an example of a fair value gap. Fair value gap. So if this market goes up or goes down, it must trade back into this gap. So now when you have something like this, now this is a place where the market was as if the market was sluggish, and suddenly you have a sudden jump. Then this place is an order block. This position is an order block. Now, between this candle, look at this long candle, look at this candle and this candle. This is a game between three candles. Now, this candle here and this candle here, they were supposed to close the gaps between this candle. So they didn't close the gap. So that means from here to this place, there is what we call fair value gap. Fair value gap. So now for this fair value gap to be here and for this order block, this sudden movement up, it shows that there was a big order here. There was an institutional order here. A particular money entered this market that pushed this market up. Automatically, this market would have just been dancing like this. They just continue to dance like this. But when there is traffic in the market, there is a trend in the market because there is movement of money. So immediately there is a heavy money enter this market, the market jumped up and went up. Now, no matter how far this market goes up, it must trade back into this fair value gap. And most times, rest on this order again to receive momentum. And this is how, when you are trading a structure, a trend, this is how you look for candles like this to determine where you are likely going to enter the market. And of course, when you have this kind of structure, you begin to wait to see the market reaction and around here for you to know. Marketers will also give you candles, combination of candles that tells you that it's ready to move. For example, when the market comes here, it gives you, for example, it gives you a small candle for a sell, then it gives you a candle for a buy. Then you continue like that. So when you see this, then you enter a buy. Then you join the trend. This is how you capture your market on structure. So today I just wanted to show you how complex the structure can be. So every structure is not as simple as the way we call it and say, higher high, higher low, higher high, higher low, higher high, higher low, then break of structure. It's not always like that. Sometimes, the inside structure can confuse you to make you think that maybe the market has started going on sell. But when you squeeze this chart and you look at your chart on bigger time frame like daily, you are able to capture the true direction of the market. I just hope this one will help you. Then we can now go back on real chart for me to be able to show you, real examples.